And next up, I'm pleased to welcome our next speaker, Ms. Prue Bennett. She is the Managing Director and Head of Investment Stewardship APAC Blackrock. She'll be discussing the topic on driving business values and sustainability through active investors. Please give her a big hand, please.
Well, thank you very much for having me here today, and thank you to the SEC, the SET and CS for organising this great event. And it really is a privilege to continue participating in Thailand in such events and to see the development of corporate governance in Thailand. So the topic I've been asked to talk about is driving business value and sustainability through active investors. And I'm going to talk about Blackrock's approach. And just before I get started on the slides, which we might start doing now. Blackrock is a very large US-based asset manager. It currently has over $6.3 trillion under management. And I've just celebrated my 8th year with Blackrock, and I still can't get my head around the size of that number. Most of our, or about half of that amount is in equities, and we have various investment styles. But the predominant investment style that we have is what's known as passive, which means the portfolio follows a particular index, or it's an iShare. And what is particular about passive investing is that selling is not an option because the portfolio is structured according to that particular index. So that makes us a long-term investor, and we do find ourselves invested in companies that have poor environmental, social and governance practices. And I have to agree with Christine that acronym ESG definitely has the G in the wrong spot. So our mission statement on sustainability is that we are an asset manager whose objective is to create a better financial future for our clients and the people they serve. And we aspire to be an industry leader in how we incorporate sustainability into, firstly, our investment process and learning across the firm, our stewardship activities of our clients' assets, the sustainable investment solutions that we can offer clients, and also in our own operations. Our expertise in sustainable investing seeks to help clients achieve better investment outcomes, and that we believe that sustainability-related issues ranging from governance to social and environment have real financial impacts. So this isn't just about a nice to have, it really is related to returns. And we're committed to providing clients with a clear picture of how sustainability-related issues affect risk in the longer term and delivering ESG solutions that improve their investment outcomes. So the 4 pillars of its sustainable investing, and I'll just read this quote which has come from our Chairman CEO, Larry Fink. Larry writes to the top, it's around 3,000 company CEOs each year. And he says, a company's ability to manage environmental, social and governance matters demonstrates the leadership and good governance that is so essential to sustainable growth, which is why we are increasingly integrating these issues into our investment process. And Larry also, in the letter that went out earlier this year, also focused on the purpose of a company and its social licence to operate. And we see how companies managing their ESG issues and their social licence to operate directly related to performance and protecting and enhancing value for our clients. So in terms of integration, integrating sustainability-related insights and data into Blackrock's investment processes, and that's across all investment styles. In stewardship, and I head up the investment stewardship function for the Asia Pacific region, where we engage with companies in a similar way that Christine does, in index and alpha-seeking portfolios alike on sustainability-related issues that impact the longer term. In terms of solution, that's more around product, delivering sustainable investment solutions that empower clients to achieve their financial objectives, and from an operational perspective, ensuring the long-run sustainability of our own firm in order to deliver the best outcomes for clients. So this is not just for clients and portfolios, but we're also applying the same approach to our own operations. So I'm just going to touch on integration of ESG into portfolio management. Okay, so we define ESG integration as the practice of incorporating material, and I want to emphasise that it is around material ESG information into investment decisions that enhance risk-adjusted returns. So we see integration as, it makes us a better informed investor and to more clearly view the risks and opportunities within our portfolios. And secondly, enhancing investment processes potentially across all portfolios and making investment decisions informed by incorporating financially material ESG information. And it's not just a values-based exercise, or as I said before, a nice to have. This is really, we're building into a core part of how we operate. So our own research seeks to develop a clearer picture of the relationship between ESG issues and longer-term risk-adjusted returns. And we believe it is feasible to create a sustainable portfolio that does not compromise return goals and may even enhance risk-adjusted returns in the longer term. Strong ESG performers tend to exhibit operational excellence and are more resilient to the perils ranging from ethical lapses and climate risks. And that's why one of the challenges that we have, and particularly in this region with our discussions with boards around ESG, and again with our focus on governance, is that it's often seen as a compliance issue, and it's part of legal and compliance that we tick the box in terms of the corporate governance structure, we tick the box in terms of the CSR report. We see ESG as being very strategic and adding value. And we often talk about countries like Korea, which has got some very poor ESG or particularly governance structures, and there's talk about the governance discount in Korea of being around 10%. And McKinsey's done some research that shows that institutional investors are prepared to pay a premium for well-governed companies. So if you look at that range from the -10 to the +16, this is about value and reducing cost of equity. So there's a definite financial argument for incorporating ESG into our processes and for engaging companies to drive that understanding, to move it from compliance into a strategic issue for the board. Now, we've also recently published a paper called Sustainable Investing, a Why Not Moment, which takes a deep dive into equities, fixed income and real assets and showcases big data research and also focuses on our engagement efforts. And that publication is on our website. But some of the observations in that publication is ESG has a lot in common with existing quality metrics, and this implies ESG-friendly portfolios could lag on risk-on periods but be more resilient in downturns. New benchmarks and products are making ESG investing more accessible across asset classes and regions. Data is improving but still patchy, and it is critical to go beyond ESG headline scores for alpha generation. Early evidence suggests that focusing on ESG may pay greater dividends in emerging markets, and I definitely support that, just based on my experience. And issues such as shareholder protections, natural resource management and labour relations can be important information differentiators in the emerging markets world. So we're constructing a framework to consolidate multiple ESG data sources into a useful decision metrics for investors. And at the moment, there's disparate sources of sustainability data. I think everybody has heard of, and I'm sure a lot of companies in here are covered by MSCI and also Sustainalytics. And it's interesting that there's some research being done that's showing absolutely no correlation between the ESG metric ratings of MSCI and the ESG ratings of Sustainalytics. My personal view of ESG ratings is that I don't believe you can come up with a number or a figure by adding an E score, an S score and a G score. We definitely look at E and S through the G lens, and that's about getting a quality board of competent people with a diversity of skills that understand the business. That board will understand the company's exposure to environmental and social issues and better manage those issues than an incompetent board that doesn't demonstrate the characteristics that we are looking for. We're also looking at using big data, artificial intelligence, machine learning processes to generate our own internal data to be able to get a better understanding of companies and ESG risks. So we view ESG integration as an evolution than an endpoint, and I don't think that's any different than the companies that we're invested in, that their reporting is evolving around how they report on ESG. Information going to the board is changing, and it needs to, because there was research done that shows that in 1975, when you looked at the market cap of an average company, 75% was represented by tangible assets and 25% by intangible assets. Today it's completely reversed. 75% of the value of the market cap is now in intangible assets and only 25% in tangible assets. So that's the value that needs to be maintained and enhanced by the board. And the board needs to have that understanding and report to shareholders around that value creation, not just about the physical and financial assets that the company has. So I think we're all on a journey here. And I also don't talk about best practice. We talk about leading practice. No one has got to best practice yet, and I don't think we will get there, because we should always be thinking of what we're doing and how we're reporting things, and continually being focused on improving. So just in terms of the ESG integration spectrum, it started off as being ESG aware, ESG aligned, and we've got to move down to the right-hand side of that, which is ESG advanced. So I'm going to touch on investment stewardship now, which is the function that I head up in Asia Pacific, and as a fiduciary for our clients. And to quote Michelle Edkins, who is the global head of investment stewardship, as a larger investor, we are able and feel responsibility to monitor the companies in which we invest, and to engage with them constructively and privately, where we believe that would help protect clients' interests. As a fiduciary investor, Blackrock evaluates how companies manage the material sustainability-related risks and opportunities within their business. So we do that through direct engagement with companies, and we do have engagement priorities, and I will talk about that in a moment. Proxy voting, we vote at all shareholder meetings. We have our own guidelines, and they are on our website. In fact, they form a very good engagement tool, and we share those with companies. In Asia we have specific guidelines for or APAC for Australia, Hong Kong, China, and our Chinese ones are in Chinese. We'll be rolling out before the end of the year Korea and Taiwan. We will soon have our own guidelines for Thailand. Now, the guidelines we develop aren't contrary to the various corporate governance codes in these jurisdictions, but they provide a perspective from an investor of what we're looking for, how we are likely to vote on issues. It's not a black and white how we will vote, because our engagement actually has a very important part of informing how we vote. But it's a very clear communication and engagement tool. And we also engage on policy issues. We've built very good relationships with the regulators in this region. When there's a debate or around changes to corporate governance codes or stewardship codes, we'll make our own submission, and we'll keep up that relationship with regulators. And we do see regulation changing a lot in this region, and in the right direction, and we certainly want to continue to be part of that. Now, the investment stewardship ecosystem, there are 4 key aspects of that. Firstly, the asset owners, and they are the economic owners of the assets, and they make some critical decisions about how their money is invested. And so they're mainly the large pension funds who are our clients. Secondly, you have asset managers such as Blackrock, and they are the fiduciary agents, and they're required to act in the best interests of their clients, who are the asset owners. Then we have the index providers. As I said, most of our equity investments, listed equity investments, are in index funds, and the index providers develop index construction rules that drive the inclusions of securities in the indexes. And lastly, proxy advisory firms, the 2 key ones being Institutional Shareholder Services, or ISS, and Glass Lewis. We use those as an input into our stewardship process. We do not default to any of their recommendations, and again, we find that engaging with companies helps us make a better informed decisions with our voting. We're also looking at, in some jurisdictions, use local proxy advisors. They often know the market better than the larger global ones. So we're using a local one in India. We've got a specialist Australian firm that we use. And we're also talking with a new firm that's just commencing in China. China is a very different market. It's a growing market. It's a key market for Blackrock. And I think it's going to help us to have a market specialist as opposed to relying on these global firms that actually don't have any presence in China. Our stewardship takes an engagement first approach, I should say. And that's because, being a long-term investor, it's important that we build that relationship with the company and that the company understands where we're coming from. And again, we're a long-term investor. We won't be selling out. Selling is not an option as a passive investor. During the proxy voting season, that's when we generate a lot of our engagements. We'll reach out to the company and say we've got an issue with it could be the general mandate, and we'll have a discussion with the company, outline why it's an issue for us. We'll listen to the company's response. Often the company is doing the right thing, it just hasn't been disclosed in the explanatory memorandum. If the discussion has been constructive and we believe that there will be change, and that change may include more information around the particular proposal in the following year, we will support management in that case. We'll then monitor that if the change has taken place. If the change hasn't taken place, we'll then consider voting against the re-election of directors. But it's building that relationship with the company is extremely important and really helps drive those informed decisions. And the proxy advisors that we use that provide us with recommendations aren't having that in-depth discussions that we are having. And we will look at their recommendations. But as I said, it's our company engagement which really drives our decision making. And we are focused on what is material to the company's long-term financial stability, and vote on behalf of our clients and funds that have delegated their voting authority to us. So last year, that's to June 2018, we engaged with just under 2,000 companies, so it's close to 15% of the companies that we are invested in. One statistic I can't tell you because we're still working on it is the percentage of the key indices. We've done a bit of work around this, but it is over 50% if you look at the value of market cap of the key indices. And there are some companies we don't engage with which have issues because our ability to influence will be limited. So we're looking at the ownership structure, issues like that before we engage. We do have, while the team globally is nearly 40 and it is growing to 60, we still have limited resources, and we have to apply our resources where it's going to have impact. We record all our engagements and we record the impact that we have. Now, when we see an outcome, it's not just because we've had 2 meetings with a company and we've achieved this great outcome. I'm sure that Christine's probably engaged, or Christine's team's probably engaged with the company as well on the same issue. So it is an outcome that can be attributed to other institutional shareholders engaging as well. But we do monitor those outcomes to make sure that what we're doing has some effect. It is unfortunate as an observation that I believe that effective stewardship is being dumbed down by the media. Active stewardship is being measured by the number of against votes. And so those asset managers that have a high level of against votes are seen in the public eye as being very active. We have a much lower level of against votes because we're engaging with management and we have this extensive engagement program. We are willing to be patient while companies change their behaviours or change their disclosures. Unfortunately, that's been interpreted as being inactive, but I can assure you that engagement is much more effective with getting change at a listed company than simply voting against a proposal. And what we do is develop a focus list of companies with whom to engage, and then we have our engagement priorities, although the subjects that we talk about generally go beyond our engagement priorities. So 5 engagement priorities are governance, which is around board composition, the effectiveness of the board, diversity and accountability. And when we're looking at the board, and I've mentioned this beforehand, it's about having a competent board, particularly in this region where we've dominated by block shareholders, both family and state. We're not just looking for a tick-the-box approach of how many independent directors are on the board. Do you have an audit, nomination or remuneration committee? Because corporate governance is seen as a compliance issue, most companies comply with the basic rules, but we're looking at going beyond that. Who is on the board? What is the selection process that the board uses to find the right directors? Does the board take into account a skills matrix, a skills and experience matrix? We had an engagement with a Korean company about 3 weeks ago, and it's a very large global operation. They've got one foreigner on the board. Most of their revenue is outside of Korea. They agree they need some more diversity on the board. So we asked, what is the process that you use? And the director responded, well, we ask everybody around the board, and when they've run out of ideas, we go and ask management. So they're not even using the services of a global search firm to do a search to find the right person and the right fit for that board. So we're really encouraging boards to use search firms as opposed to just asking the directors around the table, do they know anyone who's got some time and could come onto our board? Because it is around, and we've had sessions on this earlier today, around diversity and getting a diverse group of people around the board to drive better decision making. The second priority is around corporate strategy for the long term. And too often we look at companies' disclosures and it's talking about what's happened in the past, maybe what may be happening in the next 6 months, but very rarely is it around long-term strategy. And again, we're a long-term investor. We are going to be there for the next 5, 10, 15 years. Compensation that promotes long-termism. Compensation continues to be an issue in developed markets such as the US and the UK, with executives being rewarded, or their awards aren't related to corporate performance. So again, we're looking about with pay policies should be linked closely to long-term strategy and goals, and much more transparency. Now, in Asia, compensation hasn't been at the top of the list in terms of issues, but that's changing. The second highest paid CEO in the world last year of listed companies was in Hong Kong, and it was an outrageous structure. So we are pushing companies, even when they don't have a problem or a perceived problem, to be more transparent around how pay is set, how companies or the board or the remuneration committee assesses the performance of executives before awarding performance-based pay. We really have no transparency around this. And as some of the family-controlled companies, the next generation's coming in, we see an increase in external management coming in. The whole issue of pay, I think, is going to sort of rise to be a much more significant issue in Asia, and it's really incumbent upon shareholders to raise these issues with boards before it becomes a problem. Disclosure of climate change risk. We are encouraging companies, particularly companies who are large emitters, to disclose their climate change risk in the TCFD framework that was developed by the Task Force on Financial Related Climate Change Risk. It provides information around the governance of climate change risk, and with that we're looking at where is the board accountable. And we've had some success with some companies by, in their risk committee, which has responsibility for climate change risk, for amendments have been made to their board charter to really define the board's role and oversight in terms of climate change risk. The other three areas are around strategy and also data and targets. So the TCFD framework, I think, is very good for companies to follow. It will provide investors with a constant framework of climate change disclosure that we can incorporate into our investment processes to understand the risk exposure. And lastly, human capital management. This is an issue in a talent-constrained world, but also when I was talking about the research that showed that 75% of the value of listed companies now is intangible, most of that's in human capital. You know, particularly for firms like Blackrock, where your assets are your people who walk into the office each day and they go in the lift and then they go out. If they don't come back the next day, you don't have a business. And so it's a critical part of the value of the company that the board really has responsibility for. So with our engagements, we present an agenda, we have a plan, and we have a time frame. But that's all set and subject to change as a result of our discussions with the company. Now, we ask our investee companies to be transparent around a number of issues, and we should be transparent as well. So as I said, we have our guidelines on the website, so we're transparent around that. We disclose all our voting on our website. We provide what's called vote bulletins for very controversial issues. We don't release publicly how we're voting before a meeting because of the size of our holdings, so that information could be used in an untoward way. So we have made a decision that for controversial issues after the meeting we will disclose that. We do quarterly commentaries from each of the three regions. We disclose all our voting stats. And again, that's all on our website. So transparency is a key part of our role as well. And for the last slide, I work for a US asset management firm, so everybody is required to read this slide. It is the most important slide. So I'm not going to read it though. I'm sure everybody is capable of doing that. Look, I do have time for we've got about 3 minutes left. If there are any questions, I'm more than happy to answer questions. Well, once again, it's been a pleasure to be a part of this very, very worthwhile event. Thank you.
Thank you so much.